And welcome. Today we are going to explore the legal backbone of the bond, which is indenture. The more detail in that. So let's go through. I'll skip few slides because this is already discussed previously, so I'll not go in this. So now let's talk about the affirmative covenants, which the first type of affirmative covenants. These are the called thou shalt rules. They list the things the issuer promises to do. Generally, these are the administrative and just a good business practices. For instance, the issuer promises to actually pay the interest and principal on time. They also promise to follow the law, pay their corporate taxes, and maintain the insurance on their factories. So these are the positive best practices they are saying. These covenants do not usually stop the company from making business decisions. Like they just ensure the company remains a functioning legal entity. So this is affirmative covenants, as you can see in this diagram, correct? If we start here, um, starting at the top, we see three main basically payment obligations, which they are going to talk, then legal compliance and asset maintenance. So what is the payment obligation? Pay the interest and principal. I would make my interest payment regularly based on frequency, and I'll pay back my principal. I'll file the taxes and reports, etc., and pay this. And then I would make sure my property is insured, factory is functioning properly, all workers are insured, etc. This kind of best practices they will do. Okay, now let's move to the negative covenants, which basically not rules. Unlike affirmative covenants, these do restrict business decisions and can be costly to the issuer. Their main goal is to stop the company from becoming too risky after you have lent them money. For example, major example here is the restricting the debt. The covenants might say you cannot borrow more money if your debt ratio gets too high. Another critical one is the negative pledge. This prevents the company from issuing new debt that would be paid back before your bond in the event of a bankruptcy. So that is what a negative covenant. If you see in the diagram, correct, the nature, sorry, the nature of the negative covenants is more of a restriction. Basically, what an issuer cannot do. If you see here total debt, so they define like how much debt they can take it. And other side, if you see negative pledge, so which serves to protect the seniority, correct, this is to protect the seniority, which ensuring no new lender cuts in line in front of you, and maintaining the leverage ratio is defining total debt. So now let's talk about the negative covenant asset and cash flow protections as the next thing. So, continuing with negative covenants, we'll look at how they protect the company's cash flows and assets. Shareholder loves dividend, but bondholders hate them if the company is running out of cash. So, restricted payments covenants limit how much cash can leave the company to pay to shareholders. Similarly, we have restriction on asset disposals. The company cannot sell off its best factories and leave bondholders with the empty shell. Finally, there are rules regarding mergers. A company cannot just merge with a weaker company and walk away from its debt obligation. So these covenants ensure the assets and cash required to repay you remain within the company. So now let's look at more for a visualization perspective, correct? How that works is, so company assets and cash we are talking about, we place a protective shield here, negative covenant. This shields create a restriction as shown in the centers, correct? These are the restrictions. Stop, you cannot pay excess dividends, okay? You cannot sell your core assets. You cannot have a risky mergers, which is a smaller company or weak company, correct? So now let's talk about the four C's of a credit analysis, next small topic which we are going to discuss. To understand where the covenants fit in the big picture, we use the four C's framework of credit analysis. First, the capacity. Does the company make enough money to pay you? Second is collateral. What asset back the loan? Third is a character. Can you trust the management? And finally, the fourth C is covenants. So covenants are the legal glue that holds the other three together. They ensure capacity is maintained and collateral is not sold. Without covenants, a company with good capacity today could have a bad capacity tomorrow. So let's look at the diagram. Credit analysis is the central core. If you see here in this diagram, correct? It branches out in the four component. One is the character, and second is covenants, capacity, and collateral. So capacity deals with the cash flows. Collateral deals with the assets. Character deals with the trust, the management trust. And the dotted lines, if you see here within the covenants, is like to capacity and credit. This shows how covenants actively protect the financial health and asset of the firm. Now let's talk about the investment grades and high yield covenants. So not all bonds have the same covenants. It depends on who is borrowing. Investment grade companies like massive stable corporation usually have a loose covenants. Investor trust them, so they get more freedom. However, high yield issuers, sometimes called junk bonds, are riskier because they have a lower margin of safety. Investors demand a strict, detailed covenants. This might include maintenance covenants where financial ratios must be met every quarter. If you lend to a risky borrower, you need tighter rules. What did we learn? The riskier the borrower, the stricter the covenants must be to attract the investor. This flow shows the relationship between the risk and rules, starting the issuer risk. If we go up, which is the lower risk, okay, investment grade bonds will lead to loose covenants. So we have a loose covenants here, which grants financial flexibility. If we go down, which is the higher risk, high yield, will lead to a strict covenants. And the this says like maintenance test, which requires regular financial checkups is needed. So let's talk about violations and then summarize. So that what happens if a covenant is broken? This is called a technical default. It is a serious. The bondholders can demand immediate repayment, known as acceleration. However, usually the issuer and bondholders negotiate. The bondholders might grant a waiver to forgive the violation, usually in exchange for a fee or a higher interest rate. So let's wrap up this session. We learned that the indenture is a contract, affirmative covenants are duties, negative covenants are restrictions, and they vary by credit risk. Covenants are the mechanism that forces issuers to come to the table and negotiate when financial health deteriorates. So, if you see that if covenant violation happens, bondholder comes into actions, and this on if a, they this if you say that one path is a drastic demand for repayment and acceleration, and the common path is negotiation happens and waiver happens here, which leads to the issuer paying a fee or higher rate paid, is resulting in the default being avoided in this situation. Okay, so that's all. Thanks for watching this session. Please go through the accompanying book. Thank you. I'm stopping now.